Hi guys, welcome to Austin's Trading Hub. Let's talk about trading range. Stay tuned. Okay, so today we're talking about trading range. And as we saw in our previous video, where we talked about market structure having 5 prongs, we saw that the first prong, which was the anatomy of the market structure, was dealt with in depth in the previous video. So today we are going to be talking about the next prong, which is trading range. Like we said, there are 5 prongs: the anatomy, the mitigation, trading range, laws of structure, and reversal patterns. And today we are going to be looking at the trading range and how to apply it in our trading. All right. First thing, you need to know the difference between trading range and range structure, as the names sound similar. We've already looked at range structure in depth in the previous video. So if you've not seen that video, please go back and watch it to have a clear picture of what a range structure is. But just a little recap. We said that range structure is a part of the impulsive wave, either bullish trend or bearish trend, that occurs after the break of market structure. So we said that whenever a higher high or a lower low is taken, we have a break of structure. So anything that occurs after that break of structure is what we refer to as range structure. But today's topic is quite different. Today's topic is trading range. So the trading range is simply the range in which a trader, an institutional trader, waits for the market before executing his trades. So if market does not come into his trading range, he does not execute. So that is the difference between sniper entries and machine gun entries, where you just keep clicking buy or sell, or you just wait calmly, patiently until market gets into your zone before taking the trade. So that is what the trading range is. Now we're going to be looking at trading range in terms of a bullish trend and a bearish trend. Remember, we said that in a bullish trend, first thing that market does is to form a high, then a low, then a higher high, a higher low, and then a higher high, and so on and so forth. Now, what is this trading range in a bullish trend? The trading range is the space between the higher low and the higher high. In short, we can say that the trading range in a bullish trend is the space between the immediate higher low and the previous higher high. So the space between these two, higher high and higher low, is what we refer to as trading range. So what do we do whenever we have a trading range? Like I said, the essence of a trading range is for us to execute a trade. We don't execute a trade anywhere, just anywhere we see the market. We have to draw our market structure and have our trading range in place so that we just simply wait for the market to get into our trading range. Then and only then we'll be able to take a trade. So when the market forms this, what we expect is that it keeps forming a higher high, a higher low, a higher high, a higher low, a higher high as a range structure. And then it falls back into our trading range. And then we execute our trade to take the buy. Take note, one law or one principle behind trading trends is in a bullish trend, you always look for buys. In a bearish trend, you always look for sells. So this is a bullish trend, so we are looking for buys. So whenever market comes into our trading range, we look for buys. That is how we trade a trading range in a bullish trend. Likewise, in a bearish trend, when we have a bearish trend as this, where market forms a low, a high, a lower low, a lower high, and then a lower low. Our trading range is between the immediate lower high and the previous lower low. So to put differently, we could say that trading range is a space between the previous lower low and lower high in a bearish trend. We could also say that the trading range is between the immediate lower high and the break of market structure. So if we could say it that way for bearish, we could also say it for bullish, where we would say that the trading range is the space between the break of structure and the previous higher low for a bullish trend. All right. So, like we said for the bullish trend, when we want to implement the trading range in the bearish trend, we just simply wait for the market to form its range structure. If at all it will form a range structure, then come back into our trading range. Then and only then we'll look for what? Buy or sell? Of course, sell, because in a bearish trend, we're only looking for sells. In a bullish trend, we're only looking for buys. So, what are the contents of a trading range? What are the things we would see within a trading range? There are basically three things. We're going to see point of interest, we're going to see internal structure, we're going to see inducement. Because one question that would usually pop up in your mind is this: this trading range is very big. Of course, it is big. So why would we take a trade just anywhere within this trading range? How do we know where exactly to take this trade to minimize our risks? Because of course, the whole essence is that first for you to be a good trader, you should have proper risk management, you should have a good strategy and a proper psychology. Those are the rudiments of a good trader. So, is it just anywhere within this wide trading range we're going to take our trades? No. We're going to take our trades in specific areas within this trading range, which we are going to be looking at in subsequent videos. We're going to be going in depth into how to refine this trading range to the smallest possible area where we can comfortably take our trades. And those smallest areas where we can comfortably take our trades are what we call points of interest. So points of interest, they are, as the name implies, they are points which we have interest in. Within this trading range, there are points where within the trading range, we hope to execute our trades. So it's not just anywhere within the trading range that we execute our trades. We execute our trades at specific points within the trading range. And there are basically two types of points of interest: primary point of interest, secondary point of interest, which we're going to be looking at in subsequent videos. The next content is the internal structure. As we said in the in-depth anatomy of market structure, we said that the internal structure is a part of the impulsive wave that occurs before the break of market structure. So that is also a content of the trading range. So instead of markets using the primary point of interest or the secondary point of interest, it could as well use the internal structure. When it uses the internal structure to buy or sell, we would call that internal structure continuation, which we are going to be looking at later on. Then the last content is the inducement. Just as we have primary and secondary points of interest, we also have primary and secondary inducement. All these will be covered in subsequent videos. Of course, these are not topics under market structure, so we won't talk much about them. But stay tuned for subsequent videos and hopefully we'll cover each and every one of them. So let's look at the practical aspect of trading range and how to apply it. So as you can see, this is gold for our time frame. And let's look at trading range using this bullish trend as an example. As you can see, we have a bullish trend here. We have a bullish trend here. We have a high, a low, a higher high, a higher low, a higher high, a higher low, a higher high, a higher low, and a higher high. As you can see, this low here could not make a deep pullback into our trading range. So let's look at our structure first. Let's mark our structure. Okay, so this is our break of structure, our first break of structure. This is our next break of structure. Then we have our next break of structure. Okay, so we have our break of structures. So clearly we can see that this is a bullish trend. Why? Because we have a high, a low, a higher high, a higher low, a higher high, a higher low, a higher high, a higher low, and a higher high, which we've not seen yet. Why haven't we seen our higher high yet? Let's see. Okay, so this is our next break of structure. Okay, where are our trading ranges? Let's see. Let's see our trading range. So when market formed this impulsive wave to cause the break of structure, you can see the pullback into our trading range. So we said that this from our break of structure down to our low is our trading range. And as you can see, the market created this pullback into our trading range before taking the buy. Now, after it created this impulsive wave to cause the next break of structure, where is our trading range? Our trading range is from the break of structure to our higher low. And as you can see, the market made a deep pullback into market made a deep pullback into our trading range. Okay? Then the next, it made another impulsive wave to cause a break of structure. And after that break of structure, you can see the deep pullback into our trading range. Where is our trading range? From the break of structure to our higher low. Then the next trading range is from our break of structure here to our higher low. As you can see, market still made a pullback into our trading range. But this pullback is incomplete. It's not a deep pullback, as we would see later on. When we talk about mitigation, we would say that these previous pullbacks, this, are well mitigated. Although mitigation is not our topic for today, but just know that this pullback is not a deep pullback. Since it's not a deep pullback, it means that this are high, low, higher low, higher high, higher low, higher high, higher low, higher high, higher low. All these are range structures. So these are range structures. Let me mark this. So these are what we refer to as range structure. So, like I said, if you want to know more about range structure, if you've not seen the video on the in-depth anatomy of the market structure, please do well to watch that video. All right, so these are range structure, and we said that one importance of range structure and even subsequent sub-range structure, as you can see, there is an imbalance here and also another imbalance here. So this is a sub-range structure. Now, the whole essence of this is that market will clear all this, range structure and sub-range structure to come back into our trading range. And like we said, that this trading range right here was not properly mitigated, was not completely filled up. There was no deep pullback. So what did market do? After it went to form its range structures and sub-range structures, it came back into our trading range. When it came into our trading range, then and only then it gave us a clear indication that it wants to continue the buy. So that is when we can say that we now have a higher high. So this is our new higher high. Then we have our higher low. Then we have our break of structure here. We have a break of structure here. So this is our break of structure. So as you can see, the markets made break of structure here, break of structure here, break of structure here, break of structure here, range structure here, and then a break of structure here, and the bullish trend continues. So that is how to apply trading range. Thanks for watching. Please don't forget to like, share, and comment your thoughts about this video, and also topics that you would want us to cover in subsequent videos. And don't forget to subscribe to our channel and turn on the notification bell so that you get notified whenever we upload new contents. All right, so thanks and bye.